Welcome to Talk Tickers, your deep dive into the latest earnings calls. Today, we're unpacking the Q2 2025 results from Janus Henderson Group, JHG.
That's right. They're a pretty significant asset manager making some interesting moves lately.
Definitely. And our mission today is simple. Distill what happened, what it really means, and maybe pull out some surprising insights for you.
It's an important one, too. We saw some initial, let's say, deliberation in the market. Shares dipped pre-market right after the results hit.
Yeah, a little bit of wobble there.
But the market seemed to digest it, settling and actually ending the day slightly higher. That suggests a more nuanced, maybe constructively bullish read than you might think at first glance.
Constructively bullish. I like that.
Yeah, and we're going to explore why that might be, what caused that initial dip, but also why the stories seem to win out in the end.
Exactly. Understanding that why, especially with those initial market jitters, is key. So let's get straight into the numbers. JHG delivered a really strong quarter.
Oh yeah, largely meeting analyst expectations, pretty much across the board.
So on earnings, GAAP EPS came in at 95 cents. That comfortably beat the consensus. And their adjusted EPS, the non-GAAP figure, was 90 cents, also ahead by about 6 cents.
Solid beat there.
Revenue figures looked robust too. GAAP revenue was $633.2 million. That's up 7.6% year over year.
Right.
And adjusted revenue, $497.9 million, up 8.6% year over year, both beating consensus. Good numbers, but what's the real headline grabber here?
Well, for me, what's really eye-catching is the assets under management. The AUM, it hit a record $457.3 billion.
Wow.
Yeah, I mean, think about that. That's a significant 27% increase year over year and 23% just quarter over quarter.
That's huge growth in one quarter.
It really is. It's not just incremental stuff, you know? It's a substantial leap, especially in today's market. Just holding AUM steady is tough for some firms.
So that huge jump, what drove it? Net inflows were, what, $46.7 billion?
That's the number. And look, a major strategic partnership was definitely a huge part of that, bringing in about $46.5 billion.
Okay, so almost all of it from that one partnership.
Well, here's the crucial part. JHG made a point of saying flows were positive even if you exclude that large contribution.
I see.
Which suggests there's broader strength there. It's not just a one-off deal propping things up. They seem to be attracting capital elsewhere, too.
So a big whale, yes, but maybe some healthy schools of fish coming in, too. What about shareholder returns? Are they sharing the wealth amidst this growth?
They are. It seems like a clear commitment there. They returned $113 million to shareholders just in Q2. That's through dividends and buybacks.
Okay.
And they declared their regular quarterly dividend, $0.40 per share. It signals confidence, right? Managing growth and returning capital.
Definitely a sign of a well-managed operation.
Yeah.
Okay, so beyond those strong headline numbers, let's dig deeper. What's the real story here about their strategy and execution, the flow momentum, those partnerships?
Right, because that's where it gets interesting this quarter. It marks their 5th consecutive quarter of positive net flows.
5 in a row.
Yeah. And think about the industry context. We all know about the headwinds for active management, the shift to passive.
It's tough out there for active.
Exactly. So achieving this kind of consistency, it's a significant differentiator. It suggests they're finding ways to deliver value that resonates, you know?
And that major catalyst you mentioned, the Guardian Life partnership, that really powered the AUM growth, didn't it?
Oh, absolutely. They closed that deal, and now they're managing around $46.5 billion of Guardian's fixed income general account assets.
And that figure, $46.5 billion, that's actually more than they initially guided to, right? Yeah. I think it was $45 billion originally.
It was, which is fascinating. It points to, well, maybe Guardian's own growth, but definitely shows the trust and the potential baked into that partnership from the get-go.
Yeah, implies good things.
And looking forward, Guardian has committed up to $400 million in seed capital for product innovation with JHG.
Oh, interesting. So it's not just managing current assets.
No, it's about co-creating future products. And they've already tapped into that. $100 million of it was used to launch JHG's new Asset-Backed Securities ETF. Ticker is JBS.
JBS. Okay, let's talk about that product innovation then. How does launching something like JBS show that client-led approach they talk about?
Well, JBS is a great example. It seems designed specifically to meet a need, likely highlighted by clients like Guardian. It gives access to short-duration, high-quality, mostly fixed-rate securitized assets.
Okay.
And it neatly complements their other big success in this area, the CLO ETF, JAA, that one focuses on collateralized loan obligations, which are typically floating rate.
So JBS fills a gap, fixed rate versus floating rate?
Exactly. It rounds out the offering, shows they're thinking strategically about building out that fixed income ETF suite.
So speaking of ETFs, how are they positioning themselves in that active ETF space? It's a hot area.
It really is. And they're making serious moves. They've launched 8 ETFs globally just this year so far.
8 already?
Yep. And get this. They're now the 8th largest provider of active ETFs globally. And maybe even more notably, the 2nd largest in active fixed income ETFs.
2nd largest in active fixed income.
Wow. Yeah, it shows real product velocity and serious market penetration. They're not just dipping a toe in, they're aiming to be a leader there.
Okay, so strong in traditional, active ETFs. But they're also pushing into more disruptive tech, aren't they? Like that tokenized treasury fund.
Right, the Annamore Treasury Fund, JTRSY,
Yeah.
fully tokenized. And it saw over $400 million in net inflows in Q2 alone.
$400 million into a tokenized fund. That's substantial.
It absolutely is. And this, I think, highlights a really interesting emerging client type, these on-chain investors.
On-chain investors. Explain that a bit.
These are folks operating directly on blockchains. They're holding capital and stable coins, digital dollars, basically, often earning zero yield.
Right.
And they're looking for ways to earn something. So they're moving that capital into tokenized real-world assets, like JTRSY, to capture treasury yields but stay on-chain. JHG seems way ahead of many peers in capturing this flow.
Bridging TradFi and DeFi, essentially.
Pretty much. It's a potentially huge new avenue for growth.
Okay, fascinating stuff on the innovation front. Let's swing back to the core financials. Adjusted operating income was $167 million, margin at 33.5%. What about efficiency? Yeah,
the adjusted operating margin was solid at 33.5%. And they did see their adjusted compensation to revenue ratio improve. It dropped to 43.2% from 45.8% last quarter.
So better operating leverage, managing costs well.
Seems like it shows good cost management as revenues climb. But we should also touch on the net management fee margin. It was 47.5 basis points.
Okay.
Now, the context here is important. That big Guardian partnership, it's mostly investment-grade fixed income, lower fee stuff, typically.
Right. Scale business, but lower margin.
Exactly. So that partnership is expected to lower the aggregate net management fee rate by about 4.5 basis points. It's a mix shift, primarily. Not necessarily bad, but it's why some people might have blinked initially pre-market.
Understood. So it's about the type of AUM coming in, not necessarily fee pressure across the board.
Precisely. Important context.
And here's a detail I found really interesting. U.S. mutual fund performance fees. They were actually positive by $1 million this quarter. First time in over 10 years.
Yeah. Isn't that something? It might seem small, $1 million, but symbolically, it's huge. It signals that underlying investment performance in some key strategies is genuinely improving.
Generating actual alpha.
Generating alpha, exactly, which is what active management is all about. Great sign for investor confidence.
And quickly on leadership, they flagged a CFO transition, but it seems planned well in advance.
Very much so. Suk Grewal is set to take over from Roger Thompson, but not until April 2026. It's being framed as pure continuity and internal promotion, not a strategy shakeup, which should be reassuring for investors.
Good to know. Okay, so let's pull back again. Big picture time. What does all this mean for you, the investor, watching this space, especially given those industry headwinds we talked about?
Well, if you connect the dots, JHG seems to be navigating those headwinds pretty effectively. Their focus on, say, insurer outsourcing, like the Guardian deal.
Which seems like a growing trend itself.
Exactly. Combine that with the clear demand for high-quality credit products and their really aggressive build-out in active ETFs. It feels like they found some strong countercurrents to those broader industry trends.
Finding growth where others are struggling.
That's the idea. They're carving out differentiated growth paths.
And the performance backs that up, doesn't it? Looking back over the year leading up to, say, end of August?
It does. JHG's one-year return was around 24%. That significantly outpaced the S&P 500, which was about 15.9%, and also the Capital Markets ETF, KCE, at 14.2%.
So clear outperformance versus peers and the market, delivering alpha.
Demonstrating alpha, yes. Which is why that constructively bullish label feels right. The market initially saw the margin mix shift, maybe hesitated,
right,
but then looked closer at the durable flow momentum, the Guardian deal scale, the ETF success, the tokenization angle, and the strategic execution just seemed to win out. The end-of-day close reflected that longer-term view.
And their strategy, they frame it with those 3 pillars, right? Protect and grow, amplify, and diversify. Are we seeing concrete examples?
I think so. You see consistent growth in the U.S. intermediary channel. That's protecting the core. You see big institutional wins like Guardian amplifying strengths. And the ETF push, the tokenized funds, that's diversification. It looks like tangible execution, not just buzzwords. And even things like their improved brand strength rankings, jumping 32 spots globally for institutional brand in 2 years, that suggests their push towards deeper partnerships over just transactions is gaining traction.
Building loyalty and a stronger foundation.
Exactly, positioning them for future growth.
Okay, so lots of positive momentum and strategic clarity. That naturally leads us into thinking about how these trends might play out. Which brings us, of course, to our This Is Not Financial Advice segment.
Always the fun part. And remember, everyone, these are purely thought experiments, highly speculative. Do your own homework.
Definitely. Okay, trade idea 1. The tokenized alpha pair trade. The concept here. Go long JHG equity. Ticker JHG.
Right.
And simultaneously, short a major traditional stablecoin, maybe USDT, maybe USDC. You could potentially do this via futures or perpetuals on a crypto exchange if you set up for that.
Okay, long JHG, short stablecoins. What's the thinking?
The thesis is JHG's unique positioning in tokenizing real-world assets. We talked about JTRSY and JAA. As that on-chain capital keeps looking for yield, maybe gets more regulatory clarity, we could see a big shift out of those zero-yield stablecoins into products like JHGs. JHG's early lead gives them an edge for AUM growth from this whole new client base.
And the short side.
Meanwhile, those traditional stablecoins, they face more competition, maybe more regulatory heat, and they don't offer any yield themselves. So they could be a good hedge or short target against JHG's innovation lead in this specific area.
Interesting. Exploiting that TradFi-to-Fi bridge potential. Okay, what's idea number 2?
Trade idea 2. The insurer outsourcing arbitrage strategy. Again, long JHG equity.
Okay.
And this time, short a basket of smaller or maybe more regionally focused asset managers. Specifically ones that lack that big institutional fixed income scale or the specialized credit skills or significant exposure to this insurer outsourcing trend.
Right, so targeting those potentially left behind by this trend.
Exactly. The thesis is Guardian isn't just a one-off. It's proof JHG can execute these large, complex mandates for insurers as more insurers globally look to outsource.
Which seems likely.
JHG's scale, their proven track record now, their tailored products like JBS, make them a go-to partner. This trade tries to capture the likely performance gap between winners in this space, like potentially JHG, and those firms struggling with general active outflows and less differentiation.
Playing the divergence between scale players with niche expertise and the broader field.
Yeah.
Got it. Both definitely thought-provoking.
Absolutely. So wrapping things up then, Janus Henderson Group, a very solid quarter, record AUM, strong inflows, boosted by that key partnership, but also underlying organic growth.
And a clear innovation path. Active ETFs, tokenized assets, they're not standing still.
Definitely not. Management seems to be executing a clear strategy, adapting well, and really positioning the firm by focusing on those client partnerships and diversifying their business.
Yeah, that sustained execution in what's still a pretty tough environment for many active managers is really noteworthy. It kind of offers a playbook for how to potentially thrive.
And that convergence we talked about, traditional finance meeting digital assets, JHG's early moves there, that could really redefine things for asset managers down the line. It makes them particularly interesting to watch, doesn't it?
It really does. A fascinating glimpse into where asset management might be heading. And just the standard reminder, everything we discussed today, informational purposes only. Please don't take it as financial advice.
Absolutely. Do your own research.
Well, thank you for tuning in to Talk Tickers. We hope this deep dive into JHG's Q2 was insightful for you.
Yeah, hopefully useful.
We definitely encourage you to keep exploring these themes.
Yep.
Maybe look at how other asset managers are tackling active ETFs or this whole tokenization trend. Until next time.